98.5%. That is the efficiency number that just turned a $9 stock into one of the most talked about names in AI infrastructure. And almost nobody outside of Nvidia's inner circle even knows this company exists yet. Today on Market Authority, we are going to change that. We are going to break down two companies. One solving the biggest hidden crisis inside the AI boom, and one rebuilding a completely broken industry from the ground up. Both are trading at small cap prices. Both have serious long-term potential. And both deserve a level of analysis that most channels are not giving them. So, stay with me through this entire video because the details here genuinely matter. If this kind of deep and honest investment research is what you have been looking for, you are in the right place. This is Market Authority. Hit subscribe right now so you never miss a breakdown like this one. We do not hype, we do not chase, we educate, and we let the fundamentals do the talking. Now, before we name a single stock, I want to give you a mindset framework worth more than any pick I could ever share. Real investing means finding a business, solving a real and growing problem, and buying it at a price that gives you a margin of safety. That means you are not overpaying for future hope. You are buying at a discount to what the business is actually worth based on its earnings power and its free cash flow potential. Free cash flow is simply the money a business generates after paying for everything it needs to run and grow. It is the cleanest measure of whether a company creates real value or just burns through investor money. Combine a strong business with a reasonable price and genuine patience. And that is where long-term wealth actually comes from. Keep that framework in mind as we go through everything today. So let us start with the first company. And to understand why this business matters right now, you need to understand a crisis quietly threatening the entire artificial intelligence infrastructure build-out across America. AI at scale is an electricity monster. We are talking about enormous data centers filled with the most advanced computing chips ever built, running 24 hours a day, 7 days a week. Some of the largest AI facilities being built today consume as much power as a mid-sized American city. And here is the deeper problem. The electrical systems managing power delivery inside these data centers were not designed for this moment. The technology stepping electricity down from the grid to the actual chip doing AI computation is rooted in decades-old engineering. At every conversion stage, energy bleeds out as heat. In a facility pulling this kind of power, even a small percentage of wasted electricity means tens of millions of dollars burned every single year, plus enormous cooling costs on top of that. Solving this problem is not optional. It is an inevitability. And that inevitability is the foundation of our first investment thesis. There's a small semiconductor company built entirely around solving this problem. What makes them genuinely different is something very specific. Most power semiconductor companies specialize in one of two advanced materials: gallium nitride, which switches electrical current extremely fast with minimal waste, or silicon carbide, which handles very high voltages and temperatures far better than traditional silicon. Both materials are physically superior to old-school silicon for serious power loads, but here's the thing. Most companies pick one lane. This company has built the technology, the patents, and the manufacturing relationships to do both at a world-class level. That means they can address every single stage of the power chain inside a data center, from where electricity enters the building straight from the grid all the way down to the chip running your AI model. They call this their grid to GPU strategy. No other pure-play semiconductor company can claim that full coverage right now. They have over 300 patents backing this work and became the first semiconductor company in the world to achieve carbon-neutral certification. The competitive landscape is real. Texas Instruments, Infineon, onsemi, and Wolfspeed are all investing heavily in these same advanced materials with far larger budgets. That risk is genuine and should not be ignored. But while those giants spread resources across dozens of markets, this company is 100% focused on one problem. That focus creates speed. And in AI infrastructure, speed matters enormously. Then there is the Nvidia relationship. In May 2025, Nvidia selected this company to collaborate on power architecture for their next-generation AI factory systems. In October 2025, Nvidia formally designated them as a validated power partner for their 800-volt AI factory ecosystem, essentially telling the entire supply chain that this company is approved and trusted. That kind of institutional endorsement from the most dominant name in AI hardware opens commercial doors that take years to access any other way. And this month, February 2026, they unveiled a 10-kilowatt power platform running at that 98.5% efficiency number I mentioned at the very start of this video. For every dollar of electricity going in, only 1.5 cents is wasted. That is a world-leading number. They also locked in a long-term manufacturing partnership with GlobalFoundries to produce chips right here in the United States, which matters for supply chain security and federal contract positioning. The company is Nvidia Semiconductor. The ticker is NVTS. Now here is where patient investors separate themselves from reactive ones. On the surface, Nvidia's financials look rough. Full year 2025 revenue came in around $46 million, down about 45% from the prior year. But this decline was entirely intentional. Under their current leadership, Nvidia launched a complete strategic overhaul, deliberately exiting low-margin business lines and redirecting every resource toward high-margin, high-growth markets where their technology creates real competitive advantage. The businesses they walked away from were never going to generate meaningful free cash flow long-term. The markets they are entering, AI data centers, power grid infrastructure, high-performance computing, have the potential to generate substantial free cash flow as AI infrastructure spending accelerates over the next decade. That is the strategic logic, and it is sound. Beneath that revenue headline, the fundamentals support the case. Gross margins held steady around 38.5%. Operating expenses dropped about 24% year over year, showing real cost discipline. First quarter 2026 guidance points to 10 to 16% sequential revenue growth, signaling the bottom is behind them. Analysts tracking the AI infrastructure supply chain broadly expect companies with validated positions inside Nvidia's ecosystem to see accelerating revenue as the 800-volt architecture rolls out through 2026 and into 2027. The consensus view is that Nvidia's revenue trajectory improves materially in the back half of this year and more significantly through 2027 as production ramps. At around $9 a share, Nvidia carries roughly a $2 billion market cap. If they capture just 10% of their $3.5 billion addressable market, that translates to $350 to $500 million in annual revenue. Apply a reasonable growth multiple in an AI-driven industry, and you are looking at a $5 to $10 billion company over a 5-year horizon. The risk is real. This is a small-cap growth stock, and any execution stumble can cause sharp price drops. Size your position appropriately. Think in years, not months, and have the discipline to hold through volatility. That discipline is what actually builds wealth. Drop a comment right now. Does the AI power infrastructure thesis make sense to you, or do you see a risk worth discussing? Your perspective shapes what we cover next on Market Authority. Now let me pivot to our second company. We just covered a crisis in the physical infrastructure powering AI. But there is another crisis hiding in plain sight across America. One just as large, just as urgent, and just as long without a real solution. Stay with me, because this one is genuinely fascinating. The total economic cost of crime in the United States runs around $2.6 trillion every single year. Yet the systems Americans rely on are fragmented, outdated, and operating in complete silos. Security guards cost $25 to $65 per hour, nearly $570,000 annually for round-the-clock coverage at a single location. Turnover rates run between 100 and 400%, meaning constant hiring and retraining. Roughly 85 million security cameras are deployed across the country, and fewer than 2% are actively monitored in real time. Over 90% of alerts require human verification before any action can happen. Nobody owns end-to-end accountability. That is a $230 billion market screaming for disruption. The company working to fix this is Knightscope, ticker symbol KSCP on the NASDAQ. Based in Sunnyvale, California, they have been at this for nearly 13 years. Their approach combines autonomous security robots, AI-driven software, and trained human agents into one single integrated managed platform, not selling fragmented technology, but delivering complete security outcomes as a service. They have already logged over 4 million hours of fully autonomous operation across the United States in real-world conditions. That operational track record is a genuine competitive moat you simply cannot replicate overnight. Knightscope has 3 major product launches planned for the second half of 2026. The K7 is their next-generation outdoor patrol robot for large-scale environments. Warehouses, perimeter security, critical infrastructure, operating autonomously around the clock at up to 10 miles per hour with a growing waitlist already in place. The K1 capsule brings real innovation to emergency communication devices, a category that has seen virtually no advancement in decades. And the K1 Super Tower combines PTZ cameras with integrated street lighting in multiple configurations. Simple concept, proven real-world deterrence impact. On the federal side, Knightscope signed a 2-year partnership with Palantir Technologies in July 2025, giving them an accelerated pathway to federal accreditation and Department of Defense deployments. Everything Knightscope builds is designed and manufactured in America, which, in the current political environment around domestic manufacturing and critical infrastructure security, is genuinely meaningful positioning. As of Q3 2025, Knightscope had approximately $20.4 million in estimated cash. Quarterly revenue was $3.1 million, up 24% year over year. They have around 90 employees and roughly 10,000 machines deployed. Free cash flow is currently negative. This is an early-stage growth company investing heavily in product development and market expansion. But 8 consecutive months of over $1 million in new sales and renewals, with 1 month crossing $2 million, shows real and growing commercial traction. Analysts watching the autonomous security space point to the 2026 product launches as the key catalyst that could meaningfully accelerate revenue and move the company toward cash flow break-even. Their current market cap sits at approximately $41 million, compared to Evolve Technologies at nearly $1 billion for doing one specific security function, or Napco Security at around $1.5 billion for traditional alarm systems. Knightscope is building a far more comprehensive platform at a fraction of those valuations. Whether that gap closes depends entirely on execution. But the asymmetry is hard to ignore. So let us bring this full circle. Today we covered Nvidia Semiconductor, ticker NVTS, solving the power efficiency crisis at the heart of AI infrastructure. And Knightscope, ticker KSCP, rebuilding a broken $230 billion security industry with autonomous technology. Both are small. Both carry real execution risk. Neither is guaranteed. But both have a large unavoidable problem to solve, concrete early traction, and current prices that offer genuine long-term upside if management executes well over the next 3 to 5 years. The right approach is the same for both. Understand the business deeply. Size your position according to risk you can genuinely live with. And think in years, not weeks. The investors who build real wealth are always the ones patient enough to let a well-researched thesis develop fully. If today's breakdown gave you real value, please share this video with someone serious about long-term wealth building. That one action supports market authority more than almost anything else. And explore our other videos on this channel. Every single one is built to teach you how to think about markets, not just what to buy today. Everything in this video is strictly for educational and informational purposes only. Nothing here is financial advice or a recommendation to buy or sell any security. Always do your own thorough research before making any investment decision, and consider working with a licensed financial professional who understands your specific situation. Investing involves risk, including the possible loss of principal. Stay patient, stay disciplined, and we will see you in the next one right here on Market Authority.